Welcome back, everybody, to another episode of the Allied Advisors Podcast, the podcast for mid-market manufacturers looking to scale operations and improve that ever-important bottom line. Today's episode, I'm joined by Mr. Allen Engstrom. Allen is the Managing Director of the CFO Network, where he leverages over 2 decades of high-level expertise to provide world-class outsourced finance and accounting solutions for businesses of all sizes. With an MBA from the University of Texas at Austin, specializing in IT, entrepreneurship, and finance, Allen blends deep technical knowledge with sharp business acumen. His impressive career includes a significant tenure at Intel Corp, where he served as a program manager overseeing a 60-person team for a $60 billion data storage market strategy and managed mergers and acquisitions totaling over $4 billion. Today, based in North Little Rock, Arkansas, he is widely recognized for his ability to transform complex financial data into actionable growth strategies, helping entrepreneurs navigate everything from day-to-day bookkeeping to high-stakes valuation and finance analysis. Allen, thank you so much for carving out the time to come on the show. Really appreciate it.
Thank you, Justin. Happy to be here.
Yeah, we want to provide valuable information to mid-market manufacturers, and I am ashamed to say I have not had anybody with a financial background on the show. So maybe the most valuable information if you're a mid-market manufacturer, and I've totally skipped it. So thank you for helping me remedy that today.
I'm happy to be here, and I'm passionate about this, so I'm looking forward to diving into it.
I love it. I love it. So you and I had a little pre-meeting where we kind of went over what we were going to discuss today. And one of the topics that came up was, I was recently out on the West Coast working for a rocket manufacturer where we discussed, during those conversations that even Elon Musk had to learn the hard way that building things is one thing and manufacturing is totally different, right?
Totally different.
I'm not saying that building a rocket's easy. Obviously, it's certainly not. But manufacturing it adds another level of complexity that I think most people overlook or most people oversimplify.
Absolutely.
With you coming from the financial background, why is manufacturing so hard to capture all of the ins and outs on your traditional P&L?
Well, most people know the Intel as a company. They're, at the time that I worked for them, they were considered the world's most respected company. Not sure if they still hold that title today, but they were undoubtedly, at the time at least, the world's most complex manufacturer. And so I got up close and personal in exactly how hard it is. And you're absolutely right. Designing the tech is one thing. Actually making the widget is a whole other thing. And I would say there's even another realm. At the end of the day, after you add up the sum of all the things that you've done, you've got to make a nickel, right? You've got to have some kind of profit, if anything, to sustain the organization going forward. But hopefully, you're making enough of a return on all of that to justify the pain and suffering and sacrifice and upfront investment that you and all the other owners and even all the other stakeholders, employees, everybody, at the end of the day, you've got to make it sustainable. And it's just, manufacturing is incredibly difficult. The number one reason why it's incredibly difficult is from my perspective, just a mismatch in cash flows. And what I mean by that is, like at Intel, we had to commit at the time to build a factory was over $1 billion. I wouldn't be surprised if today it's $10 billion. But the point is, we had to commit, say 2 years in advance, $1 billion in capital to build out a factory with tooling that wasn't even invented yet, to build products that were not even invented yet. Now, that's an extreme example, but the point remains is, with manufacturing, you've got to commit upfront capital investments, right, in your factory and your equipment and a lot of other things. And then you run your material through the factory, and you've got labor. You're doing all the things. And at the end of that period, you're adding up all the dollars and cents. And again, you're hoping that the accountants show that there's a profit. The hard part is, like, if you commit, say, $1 million up front to, I don't know, build out a new tool line or something, you've got to have some assumptions about the volume of that product that's going to run ahead of time. The cost of goods sold, the labor mix, the yield on the line, and ultimately what you sell the product for in the future. And you've got to sort of match all that up and put it together in some kind of a coherent financial summary, right? That says, hey, on the front end, this is what we're assuming. And then on the back end, after it's all said and done, like, are we better off by having done this or worse off, right?
Yeah, and it's no guarantees, right? I mean,
Guarantees.
I can kind of look to the automotive market, right? 10 years ago, EVs were going to be that was the dream child, right? EVs
Right.
were the way of the future. We were all going to make tons of money selling electric vehicles. And I mean, the market share for EVs, I'm sure, has grown, but I don't think it's been the darling that a lot of the big automotive companies maybe thought or hoped it would be. But that didn't stop them from sinking tons of real capital
That's right.
into that. So it really is, to your point. That's there's a lot of risk in it, and you never know how it's going to work out, or you don't really know how it's going to work out.
The good news is with the right accounting and finance staff, like when I was at Intel, I was a finance analyst. And when we would make these kinds of decisions, we would put together like a project spreadsheet and that factored in all the minuses on the front end when we're making the investments. And then, we would plug in all the different assumptions for product mix and volume and margins and all the other cost of goods sold, materials, all that stuff. We would bake it all into a kind of a project model, so to speak. And we would do some there's financial calculations that you could do to kind of boil it all down to, is it a positive overall project? Is it positive profitability with a good return on investment, or is it something that you should pass on? And so that's the good news, is there's well established financial techniques, financial and accounting techniques that can be employed to help these business owners make good decisions and know that they've made a good decision. And if they get halfway across the river with it, they know what they need to do to adjust in order to make it a good decision.
Or when to cut bait, right? So
Yeah.
you stop throwing good money after bad. I'd imagine that's got to come into play at some point.
For sure.
So, a lot of the folks that I work with, or a lot of folks in the mid-market space, these are founder-led companies, right? These guys are technical experts. They know how to build a thing that people love and they want, and so they buy it. And then they grow and they have to bring on other people to help in the process of building. But these folks aren't necessarily financial experts, or sometimes even manufacturing experts, right?
Right.
So you only know what you know, and that's nobody's fault.
Right.
But what that tends to lead to is leaks, right? There's money that kind of gets leaked out of the organization that really goes unnoticed, because for whatever reason, the person at the top maybe just doesn't know. What are the most common leaks that you see, and how can somebody know if they're in a ship that might be taking on a little bit more water than what they expected?
Yeah, that's a great question. So the highest, I would say there's different metrics. At the end of the day, you look at profitability. We look at benchmarking a lot. So your type of business in your industry, what are the sort of what should you expect in terms of gross margins? What should you expect in terms of bottom line profitability percentages? And then another big thing that I really harp on with manufacturing companies is return on invested capital. So what is that? So that is, at the end of the day, you've got the capital base. So you've invested, right, in your factory and all of your equipment and everything like that. That's capital. If you've got some good accounting, you'll be able to look at your balance sheet and see how much invested capital you have in the business. At the end of the day, you've got to make a decent return on that capital, or every finance guy worth his salt would say you need to go do something else, right? So if you've got, say, $5 million tied up in your factory, and you're only making, say, a 3% return on that capital, Well, I could say you could sell that factory and go put that $5 million in U.S. Treasuries and sit on
Right.
the beach sipping mai tais all day and do better than that, right? So that's that's an example, but at the end of the day, you can look at other companies again, benchmark yourself on like what do other manufacturing companies. At Intel is 15%, right? So Intel had to get a 15% return on invested capital, or people like me would say it's not worth doing it, right?
Let me ask you this. So, and I don't mean to show my ignorance, but I'm about to put it on full display. When we talk about return on invested capital, is that, how does it relate to gross margin? I mean, is that essentially what you're talking about there?
Yeah, the return piece is basically the profits that you're
Okay.
generating, right? So that's when you're talking about return on invested capital. Invested capital is what you put into the business in terms of
In the
capital.
terms of
The
the
return
building,
piece, return
labor,
on invested capital is profits, cash flow. Ultimately, it's all about cash flow.
right. Yeah, since starting, the Allied group, I've definitely learned a lot about managing cash flow.
Yeah,
It's the grease that keeps all the gears turning. And I didn't appreciate that when I was just an industrial engineer. I
yeah,
didn't
absolutely.
appreciate it like I appreciate it now.
But in terms of the leaky boat, that's sort of if you're looking at those things, and that should give you sort of a indicator, right? It should be indicator light, green,
Right,
yellow, red, think in that term. So if there's say yellow or red lights in terms of profitability, gross margins,
right.
benchmark against similar companies, if your return on invested capital is low, then that would be my warning indicator light that you've got a problem, right?
Mhm.
So it could be, with that, from then we'd start sort of breaking it down, looking at your financials in more detail, um, or your gross margins too low. If they're too low, then do you have a labor utilization problem? Do you have an equipment utilization problem? Do you have a pricing issue?
How do
You
you go
sort of
about
break it down into all the different components at that point.
how do you go about making those making those decisions, right? I mean, because to your point, it could be a cost problem or it could be a sales problem, it could be a pricing problem. What's the strategy for figuring out where to focus?
Yeah, so there's lots of techniques. Utilization is a big issue. So it could be like poor labor utilization. Do you have too many people, that are idle too much that you're paying for? Same thing on your tooling and machinery capacity. What is your theoretical capacity? This goes back to engineering stuff. What is your theoretical capacity and what's your actual capacity? That's a big indicator for me. The way that you look at just the economics of a factory, one of the number one rules is keep your utilization high, right? So, say 80%
Mhm.
utilization on your labor and your equipment capacity. Usually that means that you should be doing pretty well at that point. Otherwise, you need to cut down on your costs, right, to get to match that capacity utilization.
Have you seen a lot of the struggles that I see, especially in the smaller to mid market space, is reporting is a function of labor adherence to standards, right? And good processes to get this data in so that you can look at it. A lot of times, when I talk to folks, or I talk to folks on the financial team or supply chain or in the office, let's say, and I ask them about, well, what's your scrap, what's your cost of scrap? I get the deer in the headlights look. They're like, that's kind of hard to pin down. I don't really know. And you know, to me, I'm like, wow, man, how do you sleep at night if you don't know some of these things, right? I would be beside myself worried about it if I was the one signing the front of the paycheck. Is that what is that what you experience? Have you seen that? And then kind of what's your advice to these folks to start getting better data? And maybe what's your speech to encourage them that, hey, this is important. You really need this.
Yeah, that's great question. So the thing that I've been doing this for more than 20 years, working with small businesses, and the thing that a lot of people don't understand about business owners is they're stretched so thin every single day. And I'm a small business owner myself. I understand there's 1,000 different things that I could be doing that
Mhm.
are good, good for the company, right? I just don't have enough time in the day to hit all those things right now. And usually I'm stretched so thin that sometimes I'm in danger of not being good at any one of those things. And so a lot of times it's really about focus. And one of the best techniques we have is with the numbers, the command of the numbers that we have. It's typical for each of our clients. We've got basically I call it a business simulator, a custom model that we've developed in Excel for that particular business. And we can look at, hey, if you uh, did get your gross margins up to industry average, if you did get your bottom line margins up, if you did get your capacity utilizations up, if you did minimize your scrap, here's the potential cash flow, right? And usually it's a big number, right? It's compelling, right? And so you could say, look, if you got all these KPIs, all these indicators in the green zone, like scrap, for example, if you spent some time on the front end to measure these things, look at the cash flow you could have. And sometimes it's like, $250,000 more in cash in your pocket, not only this year, but every year thereafter. That's motivating for a business owner. That really gets their attention.
And that's you kind of sparked another maybe line of thought in my brain is I'm assuming that's probably one of the things that, so a lot of my clients are family owned transitioning to private equity. If I'm a private equity guy, that's probably one of the big things I'm looking for is where are they at in terms of industries for gross and net margins? Where are they at for utilization? And, how much, and if I improve that, what can I turn this business into? And as well as, are we in a growth industry? Is there an opportunity to expand? That sort of thing.
For sure. Yeah, private equity doesn't just buy businesses to just kind of continue on as before.
Right.
Private equity has very specific demands on them to produce returns on their capital,
Right.
same principle for them. And so you would assume in every case when you're working with private equity that they are very interested in doing something different in a way that tweaks up the return on investment, right? So this is right in their zone. They are very interested in what can we do differently in the business to increase cash flow.
So if you're a family-owned manufacturing company, maybe thinking about selling, maybe you've kind of taken the company as far as you think you can, and you need some additional capital to scale operations, and you're thinking about partnering with a private equity firm. How can you prepare yourself for that? What's the shift going to be like going from family-owned operations, or maybe in your experience, going from family-owned operation to private equity?
Yeah, so that's a really we could probably have a whole episode on this topic, but of course, every private equity, everybody you work with is different, right? But I would say generically, these guys are purebred capitalists. They're not as likely to be experts in that particular business like you are, but they are purely driven by that profit motive, and it's all good. If you're an owner, part owner, if you're a participant in their fund, that's who you want to run your fund, because again, they're going to be the business guys that are going to be driving that return on invested capital. But I would expect them to be looking at you in terms of, again, like, what is the potential of this business? How can we grow? How can we increase our margins? Those sorts of things.
And you think the conversations are probably going to shift, I imagine, more in the financial vein, right? So we're not going to sit down and talk about how many widgets did you get off the line today. It's going to be more about what was the net margin on each widget you got off the line today? What was your labor utilization rate for each widget you got off the line today? So it's definitely going to get more to to the dollars and cents of the matter, which, I mean, that's what keeps us all in business anyway, right? I mean, if we're not making money, there's no reason to show up. So but I can see where that's a culture shift, right? That's a culture shock.
Absolutely. Yeah. If you Google what are the average returns to private equity, and by the way, I have been reading a lot. Private equity, the industry is suffering right now because their returns have been actually below the overall stock market returns. And it's the same principle. People that invest in private equity are sitting there saying, why should I put my money in this private equity fund when I could just put my money in a, S&P 500 ETF and make more money? And it's totally liquid. I could buy and sell it all day long. Whereas private equity, you put your money in and it's locked up. You hope you get your money back out, say 3 years down the road. So private equity has got to over the long term. Private equity has to beat the overall market, which has got to be north of 10%. It's got to be in the 15% range in order.
I mean, really, is that going to get it? I mean, would I give up the liquidity of just buying stocks?
That's why you have to deliver those above returns.
Right. I mean, you got to deliver them significantly above returns, right? I mean, multiples on your money, not 15 to 20%. I would think. Otherwise, I'll just stick it in, like you said, an S&P mutual fund, and I can sell it and take my cash out whenever I want to.
That's right.
That's
if you do business, if private equity comes into your business, you should expect that they're going to want to get those kinds of returns in your business, or else it's not going to be sustainable for anybody.
I mean, and some people could hear that and maybe take it negatively, like, oh, they're going to make this, I'm selling out, I'm going to be corporate or whatever. But I guess when I hear it, I think it's exciting. Like, hey, they're interested in this business because they see potential in scaling it and making it bigger than it is, in multiples of it, right? Not 20%, not 25%, 200%.
Yeah.
And that's an exciting thing to be a part of is how do you scale those operations? How do you grow that output and grow revenue along with it? So,
yeah, and every business owner has a right to, ultimately sell their company, of course. And, ultimately you want to cash in on all of the accumulated hard work you've put into that business. And so there's nothing wrong with that at all.
Yeah, absolutely. And, one of the things that I've kind of had to learn in my own business is, once money's gone, once you miss that target, there's no getting it back. I think if you're not a financial person, you think, well, I missed it in January, but I'm gonna make it back in April, right? Q1 was really bad, but I'm gonna get it back in Q4. But from a financial perspective, that's not how you see things. It's water under the bridge. It's gone.
Yeah, yes, it's hard mental discipline, but it's the water under the bridge thing. When it comes to financial decisions, I don't know what the right analogy is. Like it's when you're at the casino and you've lost, some money, and you go back to the ATM to get more cash because you feel like you need to make it back. And it's always from this point to the future that you have to look, right? So whatever's happened has happened, and now all you can do is optimize your decisions right now and in the future
to figure out how we're gonna start winning again, right?
Yeah, that's right.
Allen, I try not to make this a sales pitch, but I do think this might be an exception I'm going to make. If you're a mid-market manufacturer, maybe you don't have, or maybe small cap guy, and you don't have a CFO, right? Maybe your financial team is you and your QuickBooks. What would be the argument that you would make to those folks to say, hey, look, I understand this is an additional expense on the P&L, but here's the value that it delivers.
Yeah,
here's why you should call somebody like me.
So I believe in this with like every drop of fiber in me. It's probably the best investment that you have ever made in your investment or in your company. Getting somebody, and it's not, it's not even me, like just call it a fractional CFO, somebody that's got that financial perspective that we've been talking about. Goes back to what you said on the front end. They're like, these guys are heroes in my book. They're amazing at what they do. Amazing. And it would be an absolute miracle if they're also amazing at finance. No one should expect that. And so the key, as everybody knows, is like surround yourself with people who complement you. And if you're not a financial expert and a manufacturing expert, then it's easy to go out there and find somebody like me, a fractional CFO, who could come alongside you, who can make sure that you've got a foundation of solid accounting, right? So we've got solid numbers that are timely, accurate, and relevant every month, and that we're leveraging those numbers. We're doing the analysis that we talked about. We're in the cockpit helping them make decisions on the front end about how they're allocating capital. And then we've got the analysis to say, hey, when you commit this capital to whatever project it is, we've got a project model that shows here's our assumptions, here's what we need to do to make sure going forward that we are staying faithful to that original investment decision. So that at the end of the day, you're making that solid return on investment so that you can feel comfortable knowing that you made the right decision, and that ultimately at the end of the day, you are being a good steward of the capital that is tied up in this business. And if you need to make any mid-course corrections, you're more likely to spot it quick and to know exactly what you need to do. Back to focus, know exactly where you need to focus, so that at the end of the day, when we pull financial reports, say at the end of the year, we're able to say, hey, you're hitting your target gross margins, you're hitting your bottom line margin, you're maximizing your cash flow. And at the end of the day, it's all worth it, right? So all the sacrifices you've made, you're getting a good return on that investment. You can feel good about that.
What have you seen in terms of, I guess the percentage return that you've been able to help people achieve that maybe they weren't achieving before they met somebody like you?
Yeah, it's common. We'll walk into a business and maybe they're making some money. Maybe they're making low to mid single digit percentages, like say 5% profit margin. And that's okay, but it's not uncommon to see like, hey, you've got, I don't know, $1 million of capital tied up in making this 5%. That's not where you need to be. Let's do some benchmarking. Let's look at, here's these other companies. They're pulling in 15%. That's triple.
Yeah.
Like what business owner would not be interested in tripling their cash flow? That's the good news. If you've got a big capital base, you've got a big revenue base, but a small bottom line margin, even 1%, like if you find 1% inefficiency here, 1% here, 1% here, you could easily double your profits and cash flow.
And I'd imagine starting those conversations with you also has downstream effects just on organizational structure, right? I mean,
yeah,
if you come in and point out that, hey, you're inefficient in your equipment utilization, well, maybe I might go out and hire some mechanical engineers to help me get this equipment up and running more reliably, or or an industrial engineer to figure out how to do changeovers more effectively, or something like that. It could have a significant impact on what the company looks like overall.
For sure. And I think you mentioned earlier, like just the leaky boat, and there's a lot of times when we go in there and the profit's not where it needs to be. And we helped guide dozens and dozens of companies through the great financial crisis. Same goes with COVID, and we really learned a lot through those really, really tough times. One of the big lessons was not making cuts soon enough, right? So you mentioned like, we'll make it up next quarter. That's hopeful thinking. That's not a strategy. And so we're really good at saying, hey, look, that you're losing money in whatever this segment of the business. Ultimately, it's up to the business owner what they decide. But we could certainly quantify, like, hey, here's the amount of the loss, and here's what the profit could be if you made these changes. And sometimes people just need a little bit of confidence, and just a little bit of motivation to go ahead and make those changes, because sometimes they it can be tough. Any change is hard, and we recognize that.
I've been in that boat, right? I mean, where the business is not where you want it to be, and you've got resources that aren't generating the revenue that you had hoped, and but you feel like you've committed to them, right? They're part of the team. You hire them, and you feel responsible for them. So, and I did have somebody, kind of fill that role and just say, hey, I get it, but you got to cut them. You got to cut them, or nobody's got a job, right?
Yeah. One way, let's say I did that analysis, and let's say, hey, you could be making, I don't know, $100,000 more if you made this change and lopped off doing this money losing activity or whatever it may be. You've got maybe the wrong person in the wrong chair. We can quantify that. So then you could say, look, this guy in this chair is not the right fit for him. He probably knows it. If this was just a friend of yours, would you be writing that guy a check for $100,000 to help him out?
Yeah.
I don't know. It's maybe not, but at least they have that data and they could make that decision. You know what I'm saying?
And you get the support that, because I get it. A lot of times you need somebody there going, hey man, this doesn't make you the worst person in the world if you have to cut back, right? I mean, it's part of being a leader. It's part of owning a business. Sometimes you have to make tough decisions and you have to be willing to stand up for it. You have to be willing to stand up for the business first.
Or at least, make that choice. Sometimes people are like, nah, I'm good. And that's fine too.
Yep. Well, Allen, I really appreciate it so much. Thank you for carving out the time to coming and talking with us today. Obviously, finance is a topic near and dear to all manufacturers' hearts, whether they want to admit it or not. It's definitely something that we all need to increase our knowledge in, and we do that by talking to experts like you. So if folks want to follow up with you or connect with you, how can they do that?
My company is CFO Network. Just Google us, and we love to talk to business owners. So don't hesitate. We're happy to help. Our mantra is just be helpful, and so we love to have calls with folks. A lot of times, it doesn't lead to business for us, but we still come away just excited to be able to lend some good old hard-earned wisdom that we've accumulated along the way. And it's good karma. So love to talk to business owners.
That's awesome. So yeah, we'll link to the company website as well as your personal LinkedIn profile in the show notes.
For sure.
And folks, if you enjoyed this conversation with me and Allen, please do like, subscribe, share the show, tell all your friends. We want to get the message out there, and we want to help more mid-market manufacturers scale operations and improve that bottom line. Until next time, guys, see you later. Thanks again, Allen.
Thank you. Bye-bye.
Take care.